Imagine this. You've diligently saved $10,000. You feel good, you're being responsible. You might even feel a sense of pride knowing that you have a safety net for emergencies or future plans. But what if I told you that this sense of security is somewhat of an illusion? But here's the harsh truth, that money is losing value every single day. Every moment it sits idle, it's worth a little less. It's not just sitting there safely, it's slowly diminishing. It's like leaving your cash out in the rain, it's slowly being eroded away. Imagine watching your hard-earned money dissolve, bit by bit, with nothing you can do to stop it. That, my friends, is the insidious power of inflation. It's a silent thief that robs you without you even noticing. Over time, it can have a devastating impact on your savings. You see, inflation isn't some abstract economic theory. It's a real, tangible force that affects every single one of us. It's in the news, it's in the rising prices we see every day, and it's in the economic reports that often go unnoticed. It's real, it's happening right now, and it's eating away at the purchasing power of your hard-earned money. The dollars you have today won't buy as much tomorrow. This isn't about getting rich quick, it's about protecting what you've worked so hard to earn. It's about making sure that your savings retain their value over time. Remember when a gallon of gas was under $3? It wasn't that long ago, but it feels like a different era. Or when you could buy a cup of coffee for $1.50. Those prices seem almost mythical now. Those days seem like a distant memory, and that's inflation in action. It's a gradual process, but over time it makes a significant difference. The things you need and enjoy are steadily becoming more expensive. Groceries, utilities, and everyday items are all affected. The bottom line is that simply saving money isn't enough. You need to be proactive in finding ways to grow your savings. If your money isn't growing at a rate that outpaces inflation, you're actually losing ground. It's not just about saving, it's about investing wisely. It's time to stop being a passive bystander and take control of your financial future. Educate yourself, seek advice, and make informed decisions to protect and grow your wealth. So, what exactly is inflation? In the simplest terms, it's the gradual increase in the prices of goods and services over time. Think of it as your money losing its buying power. Let's break it down with a relatable example. Your daily cup of coffee. Let's say a regular cup cost $2 last year. Due to inflation, that same cup now costs $2.50. That's a 25% increase. This might seem insignificant at first, but imagine this happening to everything you buy. Groceries, gas, rent, clothes. Suddenly your monthly expenses skyrocket, and your hard-earned money doesn't stretch as far as it used to. Inflation is a sneaky thief that silently diminishes the value of your savings. If you're not careful, it can significantly impact your financial goals, from buying a house to retiring comfortably. The key is to understand inflation, and take proactive steps to protect your money from its erosive effects. We've all been told to save our money in a savings account. It's a piece of advice passed down through generations, a cornerstone of financial wisdom. It's safe, it's secure, it's responsible. Or so we've been led to believe. But what they don't tell you is that those meager interest rates offered by traditional banks are often outpaced by, you guessed it, inflation. Yes, the silent thief that erodes your purchasing power year after year. Let's say you have $10,000 in a savings account earning a paltry 0.5% interest annually. Sounds great, right? Not so fast. That small interest rate might look like it's adding up, but in reality, it's barely making a dent. If inflation is running at 3%, your money is actually losing value at a rate of 2.5% per year. This means that the real value of your savings is decreasing, even though the number in your account might be going up. Imagine working hard all year, only to realize that your savings have actually shrunk in real terms. It's a disheartening realization, but one that many people face. It's like running on a treadmill. You're putting in the effort, but you're not going anywhere. Your hard-earned money is essentially standing still, or worse, moving backward. This is a bitter pill to swallow, but it's the reality of the current economic climate. With rising costs and stagnant wages, every dollar needs to work harder just to keep up. The old adage of money under the mattress doesn't cut it anymore. In fact, it's a surefire way to lose value over time. In fact, it's actually worse because of inflation. Your money is slowly but surely losing its purchasing power. It's time to ditch the outdated notion that a savings account is enough. The financial landscape has changed, and so must our strategies. To truly protect and grow your wealth, you need to explore smarter options that outpace inflation. This could mean investing in stocks, bonds, real estate, or other assets that have the potential to grow at a rate higher than inflation. It's about making your money work for you, rather than letting it sit idly by. Inflation might seem like an invisible force, but there are very real factors driving it. One major culprit is increased production costs. Remember the global supply chain disruptions? Those shortages and delays led to higher prices for raw materials, manufacturing, and transportation. And who ultimately bears the brunt of those increased costs? You guessed it, the consumer. Another factor is the increase in the money supply. When governments print more money, it can lead to a decrease in the value of each individual dollar. It's like diluting a precious metal. The more you dilute it, the less valuable it becomes. Think about it like this. If everyone suddenly had twice as much money, wouldn't the demand for goods and services skyrocket? And wouldn't that lead to businesses raising their prices? It's a classic case of supply and demand. While we can't control government policies or global events, understanding the root causes of inflation can empower us to make more informed decisions about our money. Knowledge is power, especially when it comes to safeguarding your financial future. So how do we fight back against this silent enemy? Inflation is like a thief in the night, slowly eroding the value of your hard-earned money. It's a persistent challenge that every investor must face, but don't worry, there are strategies to outsmart it. The answer is simple. Invest your money in assets that have the potential to outpace inflation. This means putting your money into investments that grow at a rate faster than inflation. By doing so, you not only preserve your purchasing power but also potentially increase your wealth over time. Remember, leaving your money stagnant in a low-interest savings account is like watching it slowly disappear. The interest earned in such accounts often fails to keep up with inflation, leading to a gradual loss of value. It's essential to seek out investment opportunities that offer better returns. One of the best ways to beat inflation is to invest in the stock market. Stocks have historically provided higher returns compared to other asset classes, making them a powerful tool in your investment arsenal. By investing in a diverse range of stocks, you can spread your risk and increase your chances of achieving solid returns. Now, I know what you might be thinking. The stock market is risky. It's true that stock prices can be volatile, and the market can experience significant fluctuations. However, with a well-thought-out strategy and a long-term perspective, you can navigate these ups and downs effectively. And you're right, it can be. But risk is an inherent part of investing. The key is to manage it wisely. Diversification, research, and a clear understanding of your financial goals can help mitigate these risks. But over the long term, the stock market has historically outperformed inflation. By staying invested and not reacting to short-term market movements, you can benefit from the overall growth trend. Patience and discipline are crucial in this journey. A great way to dip your toes into the stock market is through index funds. These funds offer a simple and cost-effective way to gain exposure to a broad range of stocks. They track specific market indices, providing instant diversification and reducing the risk associated with individual stock picking. These are like baskets of stocks that track a specific market index, like the S&P 500. By investing in index funds, you can benefit from the overall performance of the market without having to constantly monitor and manage individual stocks. They offer diversification and are a relatively low-cost way to invest. This makes them an excellent choice for both novice and experienced investors looking to build a robust portfolio. Real estate is another asset class that has historically been a good hedge against inflation. Investing in property can provide a steady income stream through rentals and the potential for capital appreciation over time. As the cost of living rises, so does the value of land and property. Real estate investments can offer stability and growth, making them a valuable addition to your investment strategy. Plus, you get the added benefit of owning a tangible asset. Unlike stocks, real estate is a physical asset that you can see and touch, providing a sense of security and stability. Investing does come with risks, and it's crucial to do your research and consider your risk tolerance. Understanding your financial goals and time horizon can help you make informed decisions and build a portfolio that aligns with your needs. But remember, the biggest risk is doing nothing and letting inflation erode your savings. By taking proactive steps and investing wisely, you can protect your financial future and achieve your long-term goals. Before you dive headfirst into investing, there's one crucial thing you need to have in place: an emergency fund. This is your financial safety net, your peace of mind in case of unexpected events like job loss, medical emergencies, or car repairs. I recommend having 3 to 6 months worth of living expenses in a readily accessible account. This money should be separate from your investments and easily available when you need it. Think of your emergency fund as the foundation of your financial house. It provides stability and security, allowing you to weather any storm without derailing your long-term financial goals. Having an emergency fund not only provides financial security, but also gives you the freedom and confidence to make smarter investment decisions without the added stress of unexpected expenses. It's about being prepared, not scared. Let's recap the key takeaways from today's discussion. Inflation is a real and present threat to your savings, silently eroding your purchasing power over time. Traditional savings accounts with their paltry interest rates are no match for the erosive power of inflation. To protect your hard-earned money, you need to fight back by investing in assets like index funds and real estate, which have historically outpaced inflation over the long term. Remember, investing involves risks, but the biggest risk is doing nothing and letting inflation eat away at your savings. Before you start investing, it's crucial to build a solid financial foundation with a 3 to 6 month emergency fund. This safety net provides peace of mind and allows you to make smarter financial decisions without the stress of unexpected expenses. Now I want to hear from you. What steps are you taking to protect your money from inflation? Have you tried any of the strategies we discussed today? Share your thoughts, experiences, and tips in the comments below. Remember, financial literacy is a journey, not a destination. By staying informed, asking questions, and taking action, we can all achieve our financial goals and secure our financial futures. Let's beat inflation together. Don't forget to subscribe, like, and share.